It's easy for you or your spouse to get confused when talking with an advisor or planner, and the last thing you need whenever you're working with your money is to have stuff that you don't understand. So first of all, be sure that you are willing to ask questions if that ever comes up, and make sure that you're working with an advisor where you feel comfortable asking those kinds of questions. Let's break down some of these terms here. So what does it really mean for an account to be pre-tax or post-tax or taxable? So what happens whenever you invest in an investment account? So first, there's you today, there's the investment account, and there's you in the future. Okay, so now the you today, you earn money through income, and you put it into the account. While in the account, your money will earn more money through interest or dividends. And then sometime in the future, you take money out of the account, and that money has gains. Investment accounts can be boiled into three main categories. So first, there's taxable. And with a taxable account, then your money gets taxed whenever you earn your income. Every year it gets taxed, the interest or the dividends gets taxed. And when you take it out, then your gains are taxed. Common taxable accounts would be a regular savings account or a brokerage account. And the reason why it's taxed throughout is because there's no other strings attached. There's no income limits. There's no certain amount of time that you have to hold the money in the account or anything like that. Next, there's pre-tax accounts. And for a pre-tax account, then the income does not get taxed. While the money is in the account, it's not getting taxed. But whenever you are taking the money out at a later date, then the gains do get taxed. So this is most commonly your 401ks or your 403bs if you're a teacher. And so the reason why they call it pre-tax is because while it's in the account, taxes, it's pre-taxes being taken out, because that gets taken out later. Lastly, there's post-tax accounts. And with a post-tax account, then it is taxed up front. But then once the money gets into the account, then it's not taxed for the interest and dividends, and the gains are also not taxed. A lot of times these are also called tax-free accounts, because once the money gets into the account, then it's free of any more taxes. And so the most common examples of these would be a Roth IRA, a Roth 401k. So whenever you hear Roth, then Roth is equal to post-tax, where you only pay taxes up front. And then also 529 plans work the same way. I hope this helps to solve a little bit of the mystery of whenever you hear these terms get thrown around, that it gives you a little bit more understanding, because whenever you determine on what kind of accounts to use and deciding where you're putting your money, then it actually is pretty important to figure out, to understand this, to know whether you want to save on taxes now or whether you want to save on taxes later, or if you need the freedom to get to your money whenever you want to. Thanks for watching, and I will talk to you later.